Hey guys, welcome back. Great to have you, Frank and Marc. Happy New Year. We're here to talk about the outlook for FinTech. What are the big trends you're seeing now or in the horizon? And we're going to have Simon Taylor, who runs a very popular and excellent FinTech Substack, join at the half-hour mark. So with that said, brief background. Frank is one of the co-founders of QED, leading FinTech venture investor, Midas list investor, and was an operating executive at Capital One. And Marc is a venture partner at Two Sigma, is also an operating executive at Citibank. So we've got operator investors, our favorite combination. And I always look forward to learning and sharing ideas with these guys. It's great to have you both back.
Happy to be here.
Thank you. Happy New Year.
Happy New Year too. So I guess jump ball. Like what's the outlook for FinTech? I'll frame it up this way. When I was at the Money 2020 conference in October, it was physically crowded. You couldn't even get a seat. Yeah, anywhere you go, it's like you go outside actually to take a meeting because you just can't find anywhere to take a meeting. I saw, I believe, 9 fraud AI compliance firms. Like, I believe there's a need for fraud AI compliance. I don't know that if you have 9 of them that you're going to have a great outcome as an investor. I sensed a lot of cope in the venture world as well. Like, there was the brave face, things are great. And then after 1 or 2 beverages, you get the different story. So I think FinTech was been powered by the M&A cycle from Visa and MasterCard. They created a bid in the market. And I think some of that is starting to go away. It's become very consensus. So I think there are opportunities in FinTech, particularly like wealth tech, which is an underserved area. But I'm less excited about FinTech for this vintage personally. You're both professional investors. Frank does this day in and day out. Marc is a cross asset class investor. Both have deep experience in financial services and FinTech. So Frank, do you want to lead us off with your perspective? Then Marc will get you.
So not a surprise. I am probably a bit more bullish, than an outsider looking in, but that perspective helps shape, a narrative that I actually do believe in. And I think it actually starts by staring at every single major stock exchange on the face of the planet. Like, if you look at some of the top market cap companies across every single stock exchange in the world, a bunch of them are financial service institutions, right? So you're dealing with a gigantic profit pool, not just a revenue pool, but a gigantic profit pool that's really made up of a bunch of products and services that are never going away, right? So unlike some sectors that come and go, some things are in and out of favor, like the core services within banking and financial services are services that need to exist and are going to exist in some form or fashion forever. So if you think about, some of the pillars of banking, you have the storage of money, which is deposits. You have the movement of money, which is payments. You have the lending of money, which is, again, lending. You have the investing of money, which is investments. And then you have the transference of risk, which is insurance, right? And when you think about these 5 pillars, like, they serve an incredible purpose around the globe in different forms or fashion, but they are not going away. So it's not a bad place to build new businesses and figure out how to serve consumers and enterprises better with different services. Now, investing is about catching a wave that usually follows some S-curve of innovation, where you're taking something that's old, and because something new has happened in an industry, you take that new thing and you refactor whatever the business was or how it was built or how it was delivered. And you're doing it in a materially different or better way. And by doing that, you actually build a company that unseats an incumbent. So when I hear people say that they're less, excited about FinTech, I think it's really a statement about, is there another S-curve to really chase to unseat some of the incumbent models with, some new model that's actually building, again, more frictionless or a superior way of delivering that product and service. And what I would say is it really depends on the surface area that you're looking at, as well as the subsector within FinTech. So if you're looking at the US, it's much more established than some other areas around the world. Like, I just got back from a trip to Nigeria back in October, I think it was. And if you think about Nigeria, like where it is in its development of delivering financial service products to consumers and businesses, it's completely different than it is in the US. Now, whether you can build a big business there, whether it's ready, whether you can capture enough economic rent to build a big business, like that's still a big TBD. Can you overcome, issues with currency and stability and financial, regulatory issues? Like all of those things are real. But I think that places around the globe and different subsectors within FinTech, we're in chapter 1, right? And then there are other areas where we probably are in chapter 3 or chapter 5 of the story until a new S-curve really shows up for new innovation to take place. And you could argue crypto, blockchain, AI, like these could be new S-curves to invest behind. But again, that's the real question that people are asking when they say they're either bullish or bearish. And I think that's important.
So today we had the big report, and I'm placing on the screen here a slide I like to look at every quarter and marvel at in reverence. This is JP Morgan's breakout of the consumer and community bank business segment. This is their retail banking operations. And I'm going to highlight here their ROE is 33%. So the ROE is their net income divided by their equity. Think of like equity and paid in capital. And if the three of us would buy a bank, we would pay the book value, the equity. Actually, we'd pay less than that because banks on average are trading below book value. They're trading 0.6. If we were to buy this, we'd be getting 33 cents on every dollar back per year at scale. And this business would be compounding, has been compounding for a long time.
You're saying that's good.
I'm saying this is a phenomenal business. And by contrast, I look at the FinTech neobanks, Lending Club, Upgrade, Upstart, SoFi, et cetera, and their market caps are down in the dumps, and they fail to take meaningful share or deliver any meaningful ROE. So yeah, there's FinTech opportunities out there. And I think, Frank, you identified several. But the other point is like, look, if we're turning over the rocks in the marginal market, if we've got to look at like Nigeria now to go find the next big opportunity, maybe we've saturated a lot here. I'll pause there. I'm obviously more of the bearish case, but Marc, go ahead.
Yeah, so I understand the bear case. The counter is, if you actually look at the opportunity set, and you actually look at the delivery against that opportunity set, they're not necessarily the same thing. So we're coming out of an environment where growth was valued at all. Basically growth was valued over profitability. And a lot of businesses were built in a less healthy manner than in a more typical environment, right? So they were more worried about solving the customer problem than they were about delivering profit for solving that customer problem, right? The capture of economic rent was not top of mind. What you're seeing in the public markets for some of the companies that did go public, they've adjusted from this world of growth to a world of profitability, and some amazing businesses are starting to emerge that should have emerged when they were in the private markets, not in the public markets, right? So if you look at the transformation of some of we took 5 companies public in 2021. If you look at Neobank, if you look at Remitly, if you look at Flywire, like these are businesses that have basically made the transition from growth at all costs to really balancing profitability with growth. And some amazing businesses are actually emerging, and these are FinTech businesses. So I don't want to conflate the two about how businesses were built in, at the peak of madness. The way I've always talked about it is that Darwin went on vacation for a few years and now Darwin is back. And I think in this world where Darwin is back, you're both going to capture the opportunity, but build the businesses in a much more healthy fashion where you are going to see capture of economic rent.
I do like those names, by the way, and they're very different though, right? By the way, I'm long Neobank. It's a leader in Brazil. We like market leaders. And it seems like if you take a FinTech business and you grow outside of the US, it's got less competition and the margins seem to work out better and they seem to perform better, as well. Marc, what are your reactions and what's your view?
First of all, I want to say when you showed JP Morgan, possibly the difference there between, I think they've lapped all the other banks, is probably management. and they just run that bank as well or better than any other fintech on the planet, probably. They just have a great management team, and it does terrific. I was also in Africa over the holiday. I was in South Africa, and I couldn't be more negative on the international markets if I tried. And it's not, I think, and it's also my experience back at Citi is, you just saw Citi just took another write-off in Argentina and Russia. I know there's companies like Neobank and some of the other places, but I know in South Africa, they were doing load shedding. They can't even supply power to the country. The infrastructure in these places are just falling apart. I saw in Nigeria, somebody running a fintech company embezzled or took a couple of $1 billion, or was a big fraud going on there. I don't know how, as an American citizen, we can judge some of the governments and what's going on there and how people are doing business. So on the international side, I'm sort of negative. In the US, I agree with what Frank said, and I thought there was some pretty interesting, I think there's potentially some really interesting places for fintechs. One of the areas you mentioned a little bit, and I don't know if I believe it or not, but is sort of the blockchain and more frictionless tokenization of some of these asset classes, which sort of feeds into wealth management. Can you tokenize, let me back up for a second, is, the VC funds have a lot of funds. We have a lot of investments out there. And at some point, how are we going to liquefy some of these things or raise additional capital for them, especially in the fintech, is there going to be M&A, IPOs or whatever? Or can a lot of these things be tokenized, and can the private markets and can the private parts of the VC world be a little bit more liquid and a little bit more transparent, so that may create an opportunity to generate, to get, the early investors get out for later stage investors that offer different types of expertise that can sort of help things grow. So that's some of the areas I'm trying to get more optimistic on.
Yeah. The one reaction I would have to the international statement is that I will both agree and disagree with you about international. I am what I would call a pragmatic skeptic, so I look at everything for what it is and understand both the risk and the return. And when you look at some of the emerging countries and regions, and that, by the way, includes South and Central America, which are built out a lot more than some of the other areas like in India or in Africa. Building a business is about having a problem statement and a solution statement that marry together so incredibly well that you can capture lots of economic rent, right? And in a lot of these countries, like, you can actually start to see these profound problem statements for which technology could be a profound solution where you can capture economic rent. The skeptic is that there's a lot of risk that surrounds that, right? You have geopolitical risk, you have currency risk, you have other infrastructure risk that you're pointing out. Like, it's amazing when you go to some of these countries, you just see how not built out the infrastructure is, and then appreciate, how built out it is in other areas. But eventually a lot of these countries are going to come around, and at that point, the ecosystem will be ready for building or delivering what I think of as the X of X. Like, at some point, there is going to be a square of Africa. And that company is going to be valuable when the continent is ready for the square of Africa to show up. And investing, especially if you're an early stage investor, is about getting paid for risk that either gets solved or doesn't materialize. Right? Like, you don't get paid if there's no risk. Right. So a lot of these opportunities, you have to be very picky. The businesses have to be incredibly capital efficient because you're not sure that there's downstream capital that will be available. Labor costs are cheap. Everything else to deliver the services tends to be cheaper than other places around the world. But you've got lots of risk, right? So how do you underwrite a team when there's fraud in, like, just running rampant through some of the countries and regions? How do you deal with the currency risk, when that some of the currencies aren't quite stable enough? So I think it's a picker's market right now, where there are these really interesting problems being solved. And if you're very picky, you can get in to some interesting opportunities. But it's hard to be indexed against, let's say, capturing beta of FinTech in Africa or beta of FinTech in South America. Like it's not going to work.
What about tokenization?
Can I say one more thing to what Frank said? I agree, and and my view was a little bit like 2 years ago, where I felt like a lot of these investments that were being made, and a lot of people have done some in Mexico and Brazil, and I think the risk premiums that we were looking at and we were investing, not necessarily where I am, but just in general, were way too low and did not compensate for.
I don't disagree with you on that.
That's more, and I think that's changed a lot now, and maybe has swung to a more risk-adjusted rate of return. So if you're going to get 30% in the United States, maybe you're getting 60 or 70 in Brazil or Mexico. I don't know. There's some risk adjustment that
valuation adjusts accordingly for the risk.
So yes.
Frank, what's your take on the tokenization? It's a topic I'm passionately excited about. I wrote an op-ed in American Banker with Anthony Scaramucci and my friend Omid, professor of digital assets at Columbia, around tokenization on the blockchain. I look at it in two broad brushstrokes: capital markets, putting that on chain to reduce counterparty settlement risk. The other, and also create transparency, all the rest, avoiding the '08 crisis, the LIBOR shenanigans, and the second is, which I'm even more excited about, is the creator economy. I know you and I have talked about this as well before. There are so many creators that are incredibly talented, and they're gatekeeper managed because it's a finite amount of studios, a finite amount of promotion tours that they can run. And now with the rise of social media, they can develop direct distribution to the base. You can tokenize that. You can reward your followers for promoting the tour, sharing the upside. I think it's an incredible opportunity. I think securities laws limit the ability to get after that in certain ways. But Frank, what do you think about tokenization? Yeah.
A lot to unpack there. So thing number one, in a crawl, walk, run world, tokenization of money probably is the thing that we are experimenting with first, and if you think about stable coins as a way of tokenization of money, the concept that you have a ledger, a single ledger with good money on it at all times, so that you don't have to worry about settlement, it is actually a pretty magical thing if this thing really does take off and is adopted globally, right? I mean, the idea that we have tens of thousands of ledgers, that are being run around the globe. I mean, it's many thousands in the US, and probably you double that number to get to the number internationally. And to move from one ledger to another requires an entire settlement process. Really doesn't make sense with the amount of international business that's actually being done. So the concept that you can tokenize money and have a ledger that is independent of the other ledgers, where you only have to worry about the on-ramps and the off-ramps when you decide that you need to take possession of the money. And the more international business is done, the more the tokenized money can stay on rails, because it's valuable. So once you on-ramp it, you don't necessarily have to off-ramp it if people see it's something of value. And I think that just takes massive friction out of the system. And I think that's really the crawl in the crawl, walk, run.
Right. And we're past product market fit there, certainly for crypto natives. And look, you said a few minutes ago, what is FinTech? It's payments, it's lending, it's insurtech and wealth tech, a couple of categories. What's payments and lending and investing? It's moving money, managing money, securing money. Blockchain does all of those things. It doesn't explain all of FinTech, but it explains the dominant categories of focus within FinTech, which is payments and lending. So one of the themes I look at from one lens is, isn't crypto FinTech 3.0? Aren't those worlds just inevitably going to collide?
It can be, right? So, I mean, definitionally, if you think about, crypto, it is financial with technology put on top of it. It is money surrounded itself by technology, right? And it's reducing the friction of money movement, which takes place for everything that is bought or sold in the world, right? So I would call that a pretty important thing to really think about new S curves and reduce friction over time. The second level, so from the crawl to the walk, the tokenization of, for instance, loans, lending assets, or things that are going to be traded with some regularity. I find it very interesting. I mean, you and I have a lot of experience in lending, and the thing that was always a scratch your head thing that I still don't have a good answer to is, when people were looking at securitization, would run a data tape in order to understand like the performance of a book of loans. Every time you would run the tape, you'd get a different answer. Like I still don't understand it to this day, that every time that you would run a tape to understand all of the payment inflows and outflows on some vintage of loans, you actually would get a slightly different answer. Now, they're fractionally different, but they're different, and they shouldn't be. It should be exact.
I agree. I'll add to that point, right? The 2008 crisis was caused in part by, in addition to lack of incentives, but lack of transparency at the loan level. We all seen the movie of Michael Burry crawling on the floor trying to find a FICO score and tie out a number. And even today, private securitizations, of which most securitizations are, especially from the fintech lenders, are called Rule 144 securitizations, are not publicly registered securitizations, don't have loan level transparency, and they have broad autonomy into how they value and mark their book. It's absurd. And there's a conflict of interest all over again.
You spend so much time understanding definitions and how things were calculated and where the data came from and when the tape was run. And, there's so much friction involved in securitization, when in reality, there should be a truth file, right? And that truth file should say, here are all the inflows and outflows. Here's the data that came with the loan when it was originated. Here's all of the documentation. Here's everything that happened, every interaction with the customer, right? Yeah. For full transparency, where
I agree. And defense spending, same thing. We can't find a massive amount of defense spending went somewhere. We have no idea where this thing is. The Pentagon is saying we acknowledge the problem. Congress, who has oversight, we're not sure how we're exactly going to fix that. And bank balance sheets, Silicon Valley Bank. Like we're using this FDIC call reporting framework, which reports a bank balance sheet with a lag. Again, we have no idea where the commercial real estate exposure risk. Neither does the bank management team. Mm-hmm. So there should be no controversy around putting these assets on chain. So Marc, I'll get off my thumb speech here. Tell us.
No, because it's coming back to what I said. In today's world, I think we're losing trust in everything. And, I don't know if it's social media's fault or just what we listen to, or people don't do the research anymore, or we're inundated with stuff. And everything seems to have a trust problem. And, maybe it's because the population of the planet is getting too big, that we're not in little communities. I remember at commercial credit, we used to trust the person in somewhere in Arkansas because the branch manager knew him and knew that even though he had a FICO score of 400, he would pay his bill because he was a hardworking guy.
Yeah, we're past Dunbar's number, right?
Yeah, all that stuff is over with. And I don't know the reason why, but our society as a whole is having trust issues. And I'm beginning to think about whether actually the blockchain and, some of these things that we were just talking about, things like Chainlink or oracles or whatever that can create trust back on the system to help financial markets, to help people, to help creators, to help.
Totally.
And that's a 5 to 10 year outlook. I don't think this is anything happening in the next year.
Yeah. So people who know me well know that I took a nice journey through the crypto space, and Ram, like you were one of my Sherpas to help me very early on figure out the basics. And, after 2 years of spending a significant amount of time in the area, one of the areas I'm very excited about is actually NFT technology. Not necessarily the way people think about NFT as JPEGs and, projects associated with it, but NFT technology, because it's really a container for metadata where you can actually understand where the data came from an oracle, putting the data into that, metadata container. And you have self-sovereignty around that, where you can give permissions, for people to look into that container, move that container, do things with that container. So most people it's got an interesting reputation because of a lot of the projects associated with NFTs, But I find the technology a magical technology when you really get into the guts of it. So think about this. When you go to college, you graduate. And when you graduate, all of the data about the classwork you took, what your grades were, the degree that you ended up earning ends up going into a database called the National Student Clearinghouse that you, as the earner of that degree, have no access to, right? You can't see into that database. It is a protected database. All you're given is a piece of paper that no one would ever trust actually has anything to do with your degree. So, I mean, you're given a physical degree that no one would trust. And you would never show up somewhere. So you would never show up an employer and say, like, here's my degree, like, here's my proof that I went to college, right? If they want proof, they have to actually go to the National Student Clearinghouse, and they have to, with permission, get access to the information about who you are, right? Employers have to do that. The same thing with landlords. Like, if they care about, do I work at place X or place Y, and do I earn X money or Y money? Like, they have to go to a source because I can't prove it myself. But there's nothing to stop a soul-bound NFT to be basically granted to me when I graduate college that has all of the information about where I graduated from, all of the classwork I took, the grades that I ended up getting, so that I now can prove to someone, because it points to an oracle that people understand. The source of truth would be the university. And I could actually go back to that and say, look, I can look right in this container of metadata. I know where the data came from. It's absolutely certified. You did go to this school. You did take these classes. You did get, these grades. And I will have the ability to actually prove it in a self-sovereign way, right, by granting permissions. And I think that's going to be true if we fast forward 5 to 10 years, for employment and how much money you make, about things that you've accomplished, things that you own, right? So these containers for metadata that point to oracles that you can research who the oracle is just, I think, a magical technology that solves a lot of problems.
I agree. And it goes back to, Marc, your observation that trust in institutions is declining. And blockchain is a remedy to that. That is a secular trend. Trust is in decline. Trust in confidence of money, in different policy, and politicians following through on what they say they're going to do. Trust in how people report their credentials,
right?
Fraud. Trust in the lending data report as well. So
even think about credit bureaus, right? The data furnishers furnish the data to the bureaus. The bureaus then become a central source of data. There's nothing to stop you as an individual from having an NFT that basically, as the data is published to their database, the oracle publishes it directly to your container of metadata. So you can see at all times the information that's being reported about you, to lenders. And you can then grant permission to take that data and give it out to a lender or give it to someone else, if you so choose that you want to release that information.
And well, you can grant different types of permissions to different types of people, so that if they don't have to see where my address is or what my net income is, but they can see that I am good as a Boy Scout or something, whatever piece of data they need to do in order to trust me for something. I would almost, hopefully, I know it's a little weird, but I'm going to take it the next step. Is I'm in my 60s and I don't have time to really learn who a person is and to build a relationship and to build a trusting relationship with somebody. And I would hope that this type of technology over time can help me figure out, who should I do business with? Who can I trust in business? Are they trustworthy? Without spending 10 years of going out to dinners with somebody and really getting to know them and who their family is. I think, if you take this,
it's LinkedIn on chain, right? It's LinkedIn on chain verified. We also talked about Carta on chain verified. Payments on chain, it's a stable coin. That's kind of the crawl example in Frank's example. But no, I agree. And to your point on the number of people you can optimally manage in your tribe has, we're all struggling with that. And the surface area interactions increasing because of technology and social media and the fact that we are living more decentralized lives. So yeah, blockchain can address a lot of that. How do you think about AI and fintech, and perhaps even crypto too? It's funny how this topic is called fintech, and then 2/3 of the chats are on crypto, which I think makes a lot of sense actually for the reasons I gave earlier. But what are some of your, Marc? Why don't we start with you here? Like your top 3 trends, let's say, to keep an eye out for.
I am not an AI. I wish I had enough technical talent to super understand what's going on with ChatGPT and OpenAI.
We value humility and honesty, so all good.
So I'm giving that as my. But I work with and have met with a lot of smart people, at Microsoft and where I work, and to a person, everybody says this technology is magical. There's something in here that this thing is doing that we don't totally understand yet. And, whether, I heard this from a company that's very close to this, they said partially that because this is trained on the way we speak and on the way we code, and a lot of it has to do with the way we code, the computer has sort of figured out how do our brains work, and is taking that to one step further and really using that to understand actually deeper how our brains work versus how we understand our brains work. So I'm involved in a neuro hub on the West Coast, and we're trying to figure out how do we use this massive amounts of data that we're getting from 3 different universities. How do we move it and use it to compute and use the AI to figure out what are some of the insights that are coming here? And then, back to a question which everybody's talking about, is it going to be these horizontal AIs that Google and Microsoft are going to win, or are they going to be a bunch of verticalized solutions or are people going to invest in the tools and the databases and all this other stuff? So I don't know the answer to all that.
We'll have to have a focused one on that topic.
Yeah.
Simon, how are you? Simon writes a terrific fintech Substack. Should all subscribe and follow also on Twitter too. We're glad to have you. So Simon wrote out a report on 2024 outlook. So Simon, we'd if you want to share a bit more about yourself, and we'd love to walk through the 3 highlights that you have to share, and then we can react. We have some bulls and bears on the fintech here, and so it'll be fun. We're going to throw you in the deep end.
Yeah, thanks for having me, guys. So yeah, FinTech Brain Food is, I'm not a trained journalist, but I've been an operator in the space for 20 plus years and seen a few things from the back end of FinTech, and always had lots of opinions and a British accent, and that seems to carry you quite far in this day and age. So combining those two things, I started a Substack during the pandemic to really start to explain this whole embedded finance thing, and it started to take off as the rest of FinTech did, whilst we were all sitting in and we had nothing. So it's a weekly newsletter. And one of the things I did recently was look forward, as you say, at 2024. And I started to try and make some predictions, dare I say, although one of them's already been proven incorrect. I thought we might not get the ETF in Q1. I thought it was going to get delayed just as much as possible. But I'm happy to run through a couple of those highlights if you are. Yeah, absolutely. I think this is the big one for me, right? Like, it probably doesn't need saying out loud to most people, but we're reverted to a long-term trend, and the narrative doesn't seem to have gone that way. So it was, you'd love to talk about this, Ram, but it was non-consensus to believe that FinTech was probably getting oversold in the public markets, whilst everybody was like killing it, just because valuations got silly in the private markets. And then, during the everything bubble, that kind of got wild. And we've seen some of the best performing stocks being things like fintech companies, things like BNPL that was clearly going to be dead, has really made a bit of a comeback. And I think if you just move to the next one, I think what you've seen really was, we saw this capitulation in Adyen, which is, kind of this consistent star performer that just refused to die no matter what was happening to fintech stocks, and they sneezed. We also saw in the private markets, this was from gnosis.co, that there was this big gap between the NASDAQ and what was happening in some of the private market valuations. But that isn't happening evenly. Actually, you go 1 quarter forward on the next slide and you see that, wait, Adyen bounced back. And it explained to the market how it gets its growth and what drives its unit economics. And the fact that it was in the middle of US market entry and it was acquiring a bunch of licenses. It was actually acquiring banking licenses in a way that none of its competitors did. And that gave it a sustainable unit economics advantage. And people went, oh, building out infrastructure is going to suck your capex for a while and it's going to harm profits. Right, I understand that now. And so there's probably a company learning what investor relations is in that process, but there's also investors realizing that not all payments companies are created equal. And same true in the private markets.
I think that is a very important point, though, that a broader generalization that when you're in a time of change, the industry analysts and investors, they correct with an axe, not with a scalpel. Right? So they sell off whole sectors, whole pieces of business and say, this is good, this is bad, this is how we're going to adjust our portfolio. And then eventually, when things calm down, they start to examine and get to know individual logos, which is more of a scalpel. And once they start to learn the logos, they can differentiate quality from, the reason why they got the axe out in the first place and cut off an entire segment. 100%. Simultaneously, a lot of the businesses take that time to take feedback about why there is an axe, and they make adjustments to their business model to become a better business during that period. And I think Adyen is just a perfect example of that.
100%. I mean, Ram, I don't know if you have thoughts. I know you're sort of the non-consensus guy through and through. You're on mute, sir.
Sorry about that. I'm here to learn. I bring smart people together and selfishly try to get your views out on the table. Then over the weekend, I go for a walk and chew on it. And so I figure, why not just put this in a public format? I'm really curious about this slide here. And I have some follow-up questions around this because I think you hit on a few themes I've been focused on. Like the payments are a race to the bottom, right? So, the PayPal story is it's got an 11 PE ratio. This is a business with a brand. It's got distribution. It's got its own payments capability. It's launching its own stablecoin. It's an incredible team. It's well run. It was a 2021 darling. And now here it is. And payments are a race to the bottom, right? Aren't we seeing this increased competition? Stripe marked down 50%. Adyen, Shift4 was a really interesting business, by the way. I think that they're actually making money on payments volume where others haven't due to their banking license. I'd love to get your perspective and everyone's perspective on this. I mean, and you got stable coins coming out, like Remitly has got a payments capability. Everyone's going after the same opportunity. Yeah, there's international remittances, there's domestic, and there's so many variations on payments, but every one of them has a number of players getting after that. And that from what I look at that on the outside in, I say, why do I want to parse this even further? When I see competitors at an intersection, violence is going to break out. I just don't want to be around that.
I think there's something to that, right? Like there's definitely, you can undercut, but who has to undercut the most is the one that has the least premium product. And I would speculate and question how much of a sustainable R&D advantage Braintree has had since it's been acquired versus how much of a sustainable R&D advantage somebody who owns the full stack from the bank at the bottom all the way up to the payment right at the top that Adyen has. And I think those are different conversations. They really are. And how flexible and adaptable is that stack to different markets? I think it was Gerard Wade that described in one of his blog posts that WorldPay, one of the competitors in this space, which is divesting out of FIS, is like lots of little. You ever seen the thing where there's like 3 kids in a trench coat and they're trying to look like a full adult? That's the M&A strategy that has historically dominated payments, which is we'll go acquire a bunch of other payments companies, we'll increase our overall TPV, and we can fire some of the back office staff because we don't need as many people, we'll unlock some efficiencies. But the reality is you still have, what you have is 3 businesses and less staff to run all of the complexities that all work differently. And so what works on the spreadsheet doesn't work. And then you get even further behind on the R&D advantage. And the competitive advantage now in payments is your ability to convert a consumer in that payment. One of the worst experiences is I go to click pay and it just doesn't work and I have to try again. Or I get the god-awful verified by Visa 3D secure code thing and I have to go through that and then it still doesn't work. Right. I do step-up authentication. The way around that is really owning that stack and infrastructure and getting much closer to what is fraud and is not. You know, when I broke into payments, false positive ratios, i.e. the amount of payments you declined to catch one fraudster was about 20 to 1. So 20 customers got declined for one good to catch one fraudster. Now it might be 10 to 1. If you're great, you can get that down to 5 to 1 underneath. And what does that mean on the other side? It means instead of turning away 10 customers, I've just turned away 5. What does that really mean? That means more revenue for me, the merchant. So if you can demonstrate that ROI, that's going to be something as a merchant I would buy. And I think that's why BNPL has done well, because what they're really selling is more customers. Yeah. More people will come to your store, more people will buy things, and they will spend more if you use us. And that's kind of what the best payments companies can demonstrate they do, but a trench coat strategy can't.
I like the picks and shovels infrastructure point you make around, look, if you can quantify the improvement from better fraud detection and allow incremental revenue, totally get that. That's going to work great, provided that space isn't crowded and they're not 9 players trying to do the same thing, right? That's the other side of that coin, right? Can you get scale versus like a subscale business? But it's a sound model. In your mind, who's got the competitive advantage in payments? So you framed it as whoever's got the edge in converting a customer, having a clean experience, right? Taking that as a premise for now, I think folks might say, well, what about wallet capture, retention, all the rest? And who do you think has the edge in the payment space when you surveil the landscape?
So disclosure, I do own stock in Adyen, but I do think Adyen has a real meaningful advantage. But also that next generation, Nuvei, to some extent, maybe Checkout. There's like a generation behind. And obviously Stripe. I mean, this is one of the things they've sold themselves on for a very long time. But what's really starting to happen to those companies that I think is interesting, to your point about can they sustain it, is their stack is now getting unbundled. What made Adyen and Stripe really work is that they were bundled. You get all of it in one, and then they use the data to get you a sustainable performance advantage and R&D leap. But actually, let's say tokenization or fraud or something, I might want to go buy that from a specialist because they can help me convert even more. So Adyen's having to figure out how it plays in this world. You know, Stripe is the great platform. You get it all from them. They bundle everything together. If you want to have it a la carte, it'll kind of work. Adyen's trying to figure out how does it become more modular and support you in that sense, but still have that, well, you know, we own most of the stack all the way down to the bank. Therefore, we can deliver you some sustainable advantages as well. So
are they going after the same opportunity, the 4 names you mentioned? Or not? Meaning,
I think they address different segments. Certainly Stripe is their home core is like platforms and people who want it all in one and people who want to outsource it. Whereas the home core of Adyen is people who are willing to do a little bit more work. They're doing really well in the omni-channel merchant space. It's like I used to be physical, now I'm going digital. But neither of them are doing particularly well in, you know, the Square, Toast, micro merchant point of sale side. So you want to be one of those two sort of spaces. You want to be serving micro merchants and bringing new merchants into the market, like a Square, a Toast, all of those types of companies, or you're really good at serving the digital merchants at scale. And Stripe is better at the smaller end for the entrepreneur up to the platform. And Adyen has historically done better with the more scale businesses and the more international businesses.
Yeah, I would say there's a broader business building point here that I think is lost on a lot of people. So thing number one, think about a magical business like AWS. And AWS was able to consolidate millions of cost centers into a single profit center. And by having the right talent focused on a singular problem that a lot of businesses were facing, it was able to hire the right talent and was able to deliver a higher quality product at lower cost than anyone who was subscale and wasn't able to invest the way they did. Right. So I think there's going to be some of this going on, but it's about defining the problem. And I think that for a while, a lot of these payment companies have been all over the map trying to be all things to all people at all times. But, trying to figure out how to solve very distinct problems by assembling the right teams, carving it out, and being able to deliver a higher quality product at lower cost is thing number one. Thing number two is the way businesses have been built over the past 20 years. There are some good things about it, but a lot of bad things that actually violate the core tenets of good, healthy businesses. And we're about to go back into a new cycle where, an adage that I have with a lot of companies is you have to revenue your way into a good company, but you eventually have to cost your way into a great one. Right. And I think we're in that mode now, where if you actually look at the fat within these companies and the ability to actually take expense out, and it's not just expense. Taking expense out provides focus, not just focus. It provides speed. It helps you focus on the thing that gives you competitive edge. That thing then accelerates. I think that a lot of these businesses, with the availability of cheap, abundant capital, they invested in too many S-curves at the same time. They had too many pet projects within. They tried to expand their ambition in order to grow into valuations that made no sense, versus focusing on the core thing. And I think that we're about to enter this new cycle of rationalization where, again, they've revenued their way into a good business. Now they have to cost their way into a great one.
Yeah, totally agree. Focus is excellence. Less is more. Go faster. So here you've got, Simon.
We used to say that at Citi, where we used to say, in both periods of time, we'd wind up doing a lot of hobbies. And then when things got a little bit harder, we started to eliminate, all these hobbies that we were having, these little things here, there, it's just, we're seeing that in the startup world now.
That's the business cycle in a nutshell. Then throw on some monetary.
Which is point number 10 here, which is like cost optimization becomes the battleground in payments. And I think that's fair. Ram, you want to jump in?
Yeah, no, it's a great summary of the, 20. Which of these do you think is the most controversial and highest impact statement?
Ooh, that's a good question.
Things that it's a varying perception that's meaningful in terms of market impact.
Yeah, I think in terms of perception, the consumer fintech bank hitting profitability, and I mean that. Is that? Yeah. Because I think, like, if you look at Moneyline and Dave and SoFi and all of those guys, like the ones that are in public markets, if you X out the adjusted EBITDA and you actually look at the underlying fundamentals, they're a little ways off. But I do think it's entirely possible to get there for some of the ones that maybe in the private markets still. And
I agree that'll happen. I just don't know it's a big deal. You remember Silicon Valley, that HBO TV series, which was a remarkably accurate depiction of startup life, seemingly.
Yes.
Anyway, there's this one scene where I think the CEO is trying to raise money, and then the angel investor says, "Look, no, it's about revenue. You're not supposed to make money. It's about revenue growth." And I look at this, consumer fintech bank hits profitability. Then they start getting valued on rational multiples.
Yes.
Adjusted EBITDA loses its adjusted EBITDA is all about storytelling. Storytelling is a polite way to describe adjusted EBITDA.
But actually look at, again, I know our company as well, the 5 that we took public in 2021. All of them had to adjust into this world of profitability, and they actually were rewarded for it because they were punished for, the old world. So they went public at a certain value. They saw a collapse of 50 to 75%. And then they had to adjust their business models for profitability. Now they're profitable. The industry analysts understand the companies better, and now they're being valued as good businesses. So, I mean, I really think there is a shift. And, I would say probably the biggest thing that needs to be, you can either say unlearned for the bad habits or relearned for the good habits. But, the startup world needs to understand the goal is to make money at the lowest level of scale possible, and then to start capturing economic rent, right? Because it gives you maximum flexibility for where you reinvest the economic rent that you're capturing.
Yeah.
So, like, being able to make money at low levels of scale is going to be the new game within venture for at least some period of time. and it's going to be uncomfortable for founders who are making the transition from the old into the new. But I think better habits are going to be deployed in the startup world going forward. That's going to make businesses much more capital efficient, and they're going to be paying attention to profitability much sooner.
So the reason I wanted to highlight this one is my experience in the UK, where the argument against neobanks, digital banks, was always, they'll never be profitable. But actually, Bank is the fastest growing business in Europe of all the tech companies. It's absolutely crushing, led by a former banker, but it's entirely digital. And you know this as well as anybody, Frank, that if you have a ultra low cost of acquisition, cost to serve, you can deliver incredible performance on the cost side of the business if you're data driven. I know Neobank has a cheat code because they're in Brazil, but that has worked in the UK, one of the oldest markets in banking. So, you know, you see Starling has hit profitability. You see Monzo's a month-on-month profitable. Bank is massively profitable. Oak North is profitable. That's a story that I think is kind of anathema to the core messaging of the bankers and some of the analysts in the space as to how
are
so
those
that's why
private?
which one did you want to?
Sorry, are those private banks you mentioned right now, or are any of them publicly traded? Or other than Nubank, but I can pull it up.
So in the UK, your annual reports are published regardless. So they don't publish the level of detail that you would expect from a publicly traded bank, but you still get disclosures into Companies House. So you have a bit like how you get with Klarna. You know, the sort of reports are made available.
Got it. Makes sense. Marc, are there any predictions you see here that where you have a disagreement or have an issue with?
No, well, the one I was looking at, and I'd love to hear your view on it, is private credit is now a feature for any fintech company. When we're talking about wealth tech and things like that, I happen to think there's going to be a big opportunity in the private credit space. There already are a bunch of funds and already a bunch of companies setting up. But on top of that, I think there's going to be a whole new potentially funding for a whole new manufacturing and business or infrastructure business in the United States with all this new synthetic biology and all these new plants that need to get built. And I'm wondering, is that sort of the area you're talking about here? I think it could be a very, again, in the next 3 to 5 years, I think it could be a very big new business.
Let me chime in with my bear case first, and then Frank or Simon, you can give the other side. So private credit's growing quickly, 1.5 trillion asset class.
Right.
It's growing because of bank regulation, pushing credit risk out of the system. And banks are now lending to the lender, providing back leverage to private credit funds. KKR does more private credit than private equity. And same goes to their competitors now. We're investing in private credit, Lumina. We like private credit. But lending's hard. It's easy to give money out, not easy to get it back. And we saw FinTech lending 1.0 on consumer, all stripes of that, and on business, and they screwed up. Most of them, not all of them. They screwed up. They didn't know what they're doing, and they didn't have the competitive advantage on customer acquisition or data or servicing. It got commoditized. People shopped for the best loan where they could, and weren't able to maintain a hold on the relationship. So this looks to me as FinTech lending 2.0. I'm sure one or two might get through the gauntlet to the other side and do well. But do we need to learn this lesson again?
So I think the space here is not consumer. That's to Marc's point, right? Like this is not a new digital consumer lending, building a consumer book. They should have gone to a community bank that really understands them and done BNPL if that was the case, and they should have done it 10 years ago.
That I like. So enabling infrastructure for community bank, credit union, I like. That makes a ton of sense. But are we talking here about small business lending, middle market lending, practice finance for doctors? Like what's the target? What can you maybe illustrate?
Can I be a little bit more specific? Let's say the onshoring of U.S. manufacturing. There's going to be a whole bunch of new chip plants. That's one area. Synthetic biology. How do we make new coffee, cocoa, chocolate, You know, how do you build these new plants? Right now, the pharmaceutical industry has built all these plants, but they're not fit for synthetic biology. That's another area. Geothermal power, the new oil and gas of the next 50 years. You know,
a lot, yeah, what
Go
you're
ahead.
talking about does not require technology at the core of the solution, right? When you're dealing with understanding counterparty risk at that level, right? Like you have to understand counterparty risk in consumer for a whole host of reasons, but N is large and you can do it statistically. And by doing it statistically, like it works out just fine if you do it well. But when you're dealing with multi-$100 million or multi-billion dollar project loans, right? Understanding the counterparty, it can be a friction-laden process of a proctology exam by a bank in order to understand the counterparty risk and do that well. And in fact, it's more of a cost of capital game, you know, than it is a technology game to figure that out and get that right. It's not about your acquisition costs, right? It's not about the technology layer in between. It's about understanding counterparty risk and cost of capital. So and like that game, I think is best left for the big banks, you know, and some of the biggest funds, so the banks can provide the back leverage, and then these gigantic, you know, private players, you know, really can figure out how to make that work. But to me, it's not a technology play.
Having worked in global transaction banking for a few years and having worked in trade and working capital, though, the inefficiency in the big banks for doing exactly that process is still enormous, right? Like the you know, the amount of money that the cities of the world will spend on doing some of this stuff, and some of the stuff they've done in trade finance is actually pretty interesting. But that aside, the amount of people that are actually leaving those jobs to build a business that does exactly this and is being much more data driven and is building it as an entrepreneur. So what I think is the zoomed out theme, I had another slide on this, which is fintech is coming up the complexity curve. We started out in consumer. It's like an S-curve looking thing. I'm sure you'll find it. We started out in consumer, and then we went into sort of investing, and then we went into SMB, and then we get into like banking for startups. And now we're kind of going a little bit further up that complexity curve. I think it's right at the back of this report somewhere. And one of the most complex types of lending is exactly that, is infrastructure finance and so on. I don't think we're quite up there yet, but I look at the Mercuries, the Arcs, the Rose, those sorts of organizations that are not just building the kind of ability to issue venture debt, which is a complex product, right? And they're on the back end, they're taking private credit to do that. They're also making that available to platforms. I'm starting to see embedded sort of this lending capability really get extended. And I think Arc even launched their own marketplace where they'll help you secure the right private credit for your marketplace or for your platform business or for whatever it is that you're trying to do, and almost coach you into lending. So yeah, this complexity curve, we start in payments because it's easy. Then we go into retail because, you know, it's a simpler product. And then, you know, 10 years time, we start getting genuine innovation in the bowels of capital markets, and we come back around again. So this is just a way of thinking about it that I think is possible, but I take all the caveats about like, yeah, this is a hard type of lending and you have to be a specialist to be able to do it well.
But somebody can build a technology layer for the industry. So a company can emerge that provides the reduction in friction for players that actually provide private credit to these project, you know, like a project finance loan. You know, so there are ways of building out the technology layer, which are more about, you know, data room and workflow management. And I think that's interesting. At the same time, I've backed businesses in the space, and maybe it was too early in the cycle, that completely fell on their face, like in this space. And there are others that were in the middle for things like practice finance loans that did quite well, right? So some parts of the ecosystem, I think, are ready, and some parts of the ecosystem are going to be persistently stubborn, you know, because the friction doesn't affect the economics, right, of, you know, a multi-$100 million loan.
Not at that level.
It's
well, I like
very
that last point you made there, Frank, around that practice finance one work, that niche focus. For example, Encino is publicly traded. I believe they're going to do well. I think I own Encino right now. They help community banks do lending better. That fintech model makes sense. WiseTech is another one. They help small businesses, similar kind of process, but they're behind the scenes. The business originates the customer. They're not caught up in that CAC game. So I think, yeah, those opportunities do make sense. But like direct customer acquisition, origination, underwriting, and credit, especially non-consumer, is like the hardest in the world.
It's
They
hard.
don't have a credit score. They can make a business.
And think about small business, right? Small business lending has never been cracked anywhere around the globe. Like it's just one of those categories that when you stare, everyone as an outsider looks at it and says, what a great opportunity. And then you realize
So many niches.
You're going to lose money in that one.
Almost definitionally, every single small business owner has an accountant whose job is to make the business look as unhealthy as possible.
You're better off buying Dogecoin than small business lending,
Right.
not financial advice.
But I think my point may be missed here. So I was thinking specifically about the startup monument and building API level access to private credit so that you could implement it as a feature a little bit faster. That's kind of what I was thinking when I wrote that line originally. But where that made me go is if you look at what Apollo is as a business, right? They own the entire credit stack from some lenders to a marketplace to they've gone all the way through. And what would an API on the front of that look like that enables niches? What are all the small businesses you could build on the front of that if you were going to unlock that? And I think fintech starts moving into like a front end version of Apollo. That was kind of the hypothesis that I was playing with.
Totally get that. And that makes a ton of sense because Apollo has the funding capacity on the back end. They just need to originate in all these various channels. And you need these kind of like thin layer targeted customer acquisition funnels, which the fintechs can do. They can do the invoice financing, the trade factoring. So yeah, it's really, I mean, they're really marketing companies at that point with technology.
Yes.
Which is fine. That's fine. It's a nice business. Might not be IPOable, but it's a nice business. Let's shift gears to predictions for crypto. We spent, by the way, Simon.
I do have
to run.
Yeah.
Yep. Always a pleasure, Marc. We'll get lunch soon. Thank you. Again, take care. Be well until next time. So Simon, we spent talking about fintech, and 2/3 of the conversation was on crypto. It was really fascinating. Talking about the future of fintech. You can't run away from soul-bound tokens and NFTs and crypto and stable. You really can't. And so going through some of these, we talked about 1, 2. I think your point: fintech companies slowly come back to stable coins. About PayPal, it's a great point. And I don't think this point is well appreciated. PayPal executes successfully and makes a dent in the stablecoin market. That's a real embedded option in the company that's not priced. It's a great point. Right. 3, U.S. crypto regulation follows MiCA in the UK. I don't know. Hope you're right. Not sure if it will. And Frank, I'll turn to you for your reactions on this list in a moment too. A mini bull run. Yep, that's happening, right? Especially in the altcoins. Altcoins are the best performing category in crypto, by the way. It's
70 IQ ugliness. Here we go.
Happens every cycle. So volume of private markets. Can you elaborate on this observation, point number 5?
Yeah, so I'm thinking about RWAs in particular, real world assets as they call them, right? So if you look at MakerDAO, that's the volume on there is exploding, and yes, it's mostly T-bills that's been happening in that space, but the space for that and the institutional curiosity of when and how they dip their toes into that water through what vehicle is off the charts. So there's definitely an understanding that this is an order of magnitude more efficient infrastructure. Just when and how can I play, and which vehicle, which limb that's I can sort of chop off far enough from my organization can I use to dabble in this to figure out how it really works.
I like it. Makes sense. And so we talked about NFTs a bit earlier. I like the rewards angle you're highlighting here, and the superfan concept makes so much sense as well. Are you tracking any instances where this is getting traction, or do you see a particular segment or use case where this would get the most lift this year?
So it's hard to tell if the volumes make any sense because there's still a lot of ecosystems that are bootstrapping it with giveaways, right? So your Polygons, your Algorands, your Hederas, all of these companies that are doing digital collection partnerships, often it's a lot of their budget that's sitting behind the scenes. So how much can I trust the volumes? But the engagement side of the Reddit avatars is off the charts. And what's powerful about those Reddit avatars is it was never positioned as an NFT. And it went into a space where there are a lot of video gamers who are absolutely opposed to anything that looks like a quick way to make a dollar out of them, and are frankly, the most likely to just vomit over anything that seems vaguely outside of their personal values, which NFTs got squarely into. And yet Reddit has embraced that in quite a powerful way. So I think there's so much to be done when you flip this onto its head and you start using the data flywheel that comes out of having this thing that sits in somebody's wallet that can then be transferred around and can have affinity to a brand or person or something else. So that's starting to happen.
I would answer it. So I agree with what you're saying. I would answer it a little bit differently. And it goes back to a question we didn't have a chance to answer earlier on around the creator economy and what's happening there. One of the problems that I think is going to explode is that when the cost to create content comes down, like you reduce friction, more content gets created, but more content doesn't get consumed. Right. So if you think about music as an example, like you're not going to consume more music just because the cost of it went down and there's more of it out there. And therefore, the same monetization is going to have to be spread more thinly, and discovery becomes like where the competition comes. But already in some spaces like music, creators are having a lot of problems making a living because of the low level of monetization in the industry. So basically, for people who aren't aware, if you have your songs on Spotify or Apple or one of the places, you get paid $3 to $6 for every 1,000 plays. Right. So think about if you had a business where you had to go find 1,000 customers or some customers that play something a lot, and you're only getting monetization that you're, by the way, splitting a bunch of different ways, depending on how you created the song. $3 for every 1,000. It means that if you can get 1 million plays, you have $3,000 coming to you, right? Like the math of this is just incredibly difficult, and it's only going to get worse, right? Unless somehow these platforms figure out how to charge more. So you would need to play a song 52 hours straight in order to generate $3 worth of revenue for a creator that you like. Now, the alternative is for superfans, are they willing to pay 0.01 ETH? If we actually talk about this in terms of crypto, or are they willing to pay $20 or $30 in order to support, an artist that they really like? And you're actually seeing this starting to take place within the crypto community. It hasn't spread to mainstream yet. Royal actually tried to do some things mainstream. They still are, trying to innovate in the space. But, I know of some actual musicians that have built up these super fan bases. And whenever they do a release, they issue an NFT with it. And people who like that artist are supporting them. And they're actually paying $20 equivalent USD to support the artist instead of $3 per 1,000 plays, of which they're not going to play this thousands upon thousands upon thousands of time to generate the same amount of revenue. So I think in the space where the content creation is going to explode, and therefore spreading monetization thinner makes it harder for creators to make a living, not easier to make a living, even though you've reduced friction. A new battle gets fought on curation and discovery. The solution can actually be your super fans, right? And I think the infrastructure now exists for the super fans to keep you alive.
You don't have to rely on something like Patreon and a middleman, and that only works for certain industries. I got this off my shelf because it's like it's a video game, Marvel vs. Capcom 3, if you're interested. And I went out and bought, because I'm such a big Capcom and Marvel fan, the special edition many years ago. This is now quite rare, and I really like it. And I also like what it says about me, and I am a super fan of both of those brands combined. And I will pay more for that. And that's very, very common in lots of industries, sports fans, wherever there's an affinity to something. We have this in the analog world. We don't have it in the digital world. And the amount, so as another story, my dad had all of my old video games stored in his house. And I was holding them there until I got a house big enough to store them all in. And he didn't realize that and sold hundreds of thousands of dollars worth of unique artifacts. Shout out, Dad, I love you. Long since forgiven. But he didn't know what they were worth and what they meant to me. But if I had something that could be sustainable and digital, what does that kind of look like? So, there are pros and cons to things that are hackable, but I think the pro is that with digital, you've got something that might survive longer than Netflix does. You've got something that might survive longer than the stores do. I think Sony had an online streaming service, and people bought content on it, a bit like iTunes, and then it shut down, and their content's gone forever. People who had the Nintendo Wii U and the Nintendo Wii, there are video games that they bought and paid for digitally that are no longer accessible to them, that they can't play anymore, that have just completely vanished. That doesn't happen in this world. So I do think there's something to be said for that.
Very exciting. Like FinTech, and here we are about NFTs, and crypto is inescapable to the future of FinTech. This is just a quick excerpt from the op-ed we wrote in the American Banker last week. I'm very excited about tokenization, especially on culture, because that's the high ground. People value culture. That's what people spend their time, energy, and attention and have interest in. And if you can allow creators to monetize that and extend out the long tail to artists that are just as creative and work just as hard as Taylor Swift, they are just as creative. It's just that they're not in our awareness set. We don't consider them. We might know who they are in our private lives. They're just not a part of the lucky crowd that got selected by the gatekeeper in LA because they had 3 slots to fill. So, I think that's great for the humanity if we can grow that, especially in a world that becomes increasingly decentralized as you have smaller, more efficient AI-first organizations. So, tokenization and NFTs and creator economy, I think they go hand in hand. Let's see. Any concluding thoughts on FinTech? Frank, I don't think we got to your top 3 long-term forecasts, but if there are any themes you want to hit on high level, go for it.
Yeah. Look, so I'll go back to what I said at the beginning, which is ultimately the pillars of financial services aren't going anywhere. Like, these are very, very important things that are going to be durable for, the history of humanity. Like, we have to consume these type of products and services because of the way we live our lives. So it's a good foundation, good hunting grounds for finding kind of the next wave of seminal companies that can replace some of the incumbents. And I think the key is investing behind new S-curves and figuring out where those S-curves are breaking and answering almost answering the most important question about why now. People forget about that, but it's one of the most important questions in making a good investment decision, because being too early is the equivalent or worse than being wrong. You could end up pouring a whole bunch of money into something where the world isn't ready for it, which, by the way, is very frustrating for everyone involved. I've done that a number of times where the thesis was right and the timing was wrong. But I think the key is identifying these S-curves and making sure that you understand them, making sure that the companies are building something that actually is a reason for existence relative to the incumbents. And, then you have a team that can actually navigate all of those issues. And when I look at all of that together with the global footprint that we have around FinTech, I'm actually pretty bullish. You still have to be very careful, though, but I'm bullish on the prospects in the space.
Simon, any concluding thoughts? So Simon delivered the bull case for FinTech here. Any thoughts? By the way, if you have any instant reactions on PayPal or Shift4, would love you to take on that. So PayPal, I feel like it's the topic every day or week now. I put it on my stalking list. I track it and watch it fall until one day it stops falling.
I wish I followed results season as close as you. I haven't even seen it. I did day jobs and kids and all kinds of stuff.
Oh, yeah. Tell me about it.
I mean, look, if I was to say 12 months ago, I thought it was kind of peak fear. I think we're sort of in this fog now with FinTech where, quality is emerging, but how much more emerging can it do? And the IPOs are going to be really what drives it up or down. Like, if we see some big companies come to IPO in the FinTech space, market reaction to that's going to really tell us a lot, as are the fundamentals underneath them. So the ordering of them and the sentiment's going to be interesting. I'm going to get out the popcorn and see what happens next. It's a lot harder to say where it's gonna head, because it was really kind of obvious when it got overhyped, oh, it's going to correct, and when everybody overcorrected, oh, we're going to kind of come back around. Now what happens in macro and what happens everywhere else, don't know. Don't have a crystal ball on that stuff. That's weird and hard and difficult, and you need people like Ram who can answer that question. But when it comes to sort of more broadly, I do think we've only just scratched the surface of financial institutions and companies properly actually getting the productivity benefits of AI and machine learning. If you compare how a Google thinks about using a neural net, like the answer is a neural net. What's the question? They just play with data in a fundamentally different way. Even at the most cutting edge fintech companies, they're not quite there yet. The models are smaller. They're not deploying it in nearly the same way. They still kind of live action role play being a bank, even though they're using a lot more tech. They're 100 times more productive, but the departments kind of do similar things because they're managing similar risks, and they report to regulators who kind of expect them to have a process for that thing. And so also you've got the whole rules about, fair lending, and is it explainable around AI? So there are, sort of headwinds against using it. But I think there's a lot of room to run if you're really getting good at AI in fintech. And AI has actually mean machine learning. Gen AI's got a ways to go yet, because that's on a whole other conversation. But machine learning feels like a technology whose time has come. And with a couple of notable exceptions, it's usually deployed as a specialism, even in the biggest institutions. We use it here and really specialist, and I think that's going to start going wider. That's kind of what I'm looking for.
Well, I'll wrap up with this slide again I shared earlier with the JP Morgan Consumer Bank, and I believe there's a character in Chinese where challenge and opportunity are the same term. Like JP Morgan is the prize. Their balance sheet and their P&L is the prize. They're still compounding an ROE of 33%. So fintech has, as of yet, not attacked the fortress or made a dent in the wall of JP Morgan. So we got a long way to go. And I think fintech, deep down inside, a lot of fintech wants to be a bank. I think that's a non-consensus take on fintech. They like the bank deposit model, the bank charter, and the special privileges that banks can do. And blockchain can play a meaningful role in chipping away at that, because you don't have counterparty risk, you don't have settlement risk, you have transparency in data. So more to come. This was a real treat. Thank you both. We'll see you again soon. We'll have to do it again. This was a lot of fun.
Thanks for having me, guys.
Talk soon.